Okay, I'm going to talk about chapter 5, Introduction to Valuation, the TVM, the time value of money. So this is a concept that are not completely strange to you. If you have taken the personal finance course, you must be very familiar with this concept. Okay, so we will talk about the future value. Okay, we're going to talk about the future value and the effect of the compounding. We are going to talk about present value. What is present value? And when we talk about present value, the effect is called discounting. And that's pretty much we're going to focus on today. So here are some basic definitions. So present value, what do we mean by present value? So basically, present value is if you draw a timeline, okay, so the present value would be the early money, okay, the early money. So whatever the money you have now, right, the value of that is the present value. You are not thinking about the value in 10 years, okay? So so that will be the future value. So the future value will be the later money on a timeline, okay? So if now I have $100, okay, I deposit into the bank, I earn interest 5%, okay, and so next year, at the end of the first year, I'm going to have more money because of the interest. So the present value would be 100, okay, and then the future value would be the 100 plus the interest I earned. So the present value are the earlier money on a timeline, and the future value are the later money on the timeline. The interest rate, so there are different proxies for the interest rate. So you're gonna also hear some concepts like a discount rate, okay, cost capital, opportunity cost of capital, and required return. So these different terminologies, sometimes we use them as the rate in this calculation. Okay, they are not exactly the same. They are not the same concepts, but we are using them sometimes for account for this rate that we are using the calculation. So, for example, cost of capital, right? Cost of capital would be, let's say, for a corporation, for an organization, corporation, they need to raise the capital, right? So what's the cost of capital? And later on, we can learn. So how much does it cost the corporation to raise capital, right? So for example, they are able to get capitals money from the bank, and the bank charges them an interest rate of 2%, right? So then that borrowing rate will be part of the cost of capital, right? So and in the same time, they can also raise capitals from the stock market, right? And they pay dividend. So what's the rate of the dividend return, right? And also, later on we're going to learn about capital structure, right? So we in the future chapters we are going to calculate what's the cost of capital, right? So so that'll be one idea, one way for the rate in this calculation. Required return, right? As a business, I probably set up myself a goal that every year I want to achieve a 10% of return, right? So that would be also something I can use in this calculation to bridging the present value and the future value. Okay, so basically this rate, we call it interest rate, but many times this rate is really a bridging between the present value and the future value. It could mean different rate for different people, but these four candidates: discount rate, cost of capital, opportunity cost of capital, required return, this could be used as this bridging rate. So I will give you one example, okay? So suppose that you have $1,000 now, you decide to deposit that into the bank, and you earn 5% rate each year. So what's the future value in 1 year? Okay, so 1 year after, what is the value of the money? Okay, so you see, this is the timeline, and now that's the present. Now that's the present. You have $1,000, so that will be the present value, right? This is early money, right, on this timeline. And you are saying, what about in 1 year, at the end of year 1? Okay, so what is the future value? How much the value would be 1 year after? So here you have to consider that you earn some interest for this 1 year period of time. So how to calculate interest? You use your balance, $1,000, that's the beginning balance, multiplied by the interest rate, which is the 5%. So that's 0.05. So 1,000 times 5%, that's $50. So after 1 year, because you deposited $1,000, you are going to earn $50 interest. So add them up together, okay, you are going to have a 1050. You are going to have a 1050, right? So the increase to the value is due to the interest. So your future value in 1 year would be $1,050, okay? And now, what about year 2, right? What about year 2? So let's say you deposited for 2 years, okay? So what happened for the second year? Well, for the second year, because the time value of money, you are still earn interest, right? So this time, the interest is calculated by $1,050 times 0.05, right? Because that $50 is earned by you and it stayed in the bank, right? It's your money. So starting at year 2, your balance is $1,050. And so this is the base on which that you are going to calculate your interest, right? So you use 1,050 times 0.05. The calculation tells us you earned $52.50, okay? So now you're adding the second year's interest to the beginning balance of the second year. So you're gonna have $1,102.50, okay? So that will be the future value in 2 years, okay? And now take a look at the calculation, okay? So you always start with 1,000, that's your initial present value, right? And you use a factor. So the first year's factor is 1 plus the interest rate to the power 1. The second year, you have the present value, you have the factor, right? The compounding factor, 1 plus interest rate. But this is second year, so to the power 2, okay? So these two numbers are the later money on the timeline. So these two numbers are called the future value. So based on this simple illustration, we could quickly come up with a formula connecting future value with the present value. So it's based on the present value multiplied by a factor that is determined by 1 plus the interest rate and to the power the number of the years. Okay, so this is the formula. So future value equals present value times 1 plus r to the power t. So r is the period interest rate. In this case, it's annual interest rate, 5%. Okay, so the it's expressed as decimals, right? So basically, so the 5%, the r is not equal to 5, right? The r is expressed as decimals. So you have to use the decimal, r equals 0.05 in the calculation. T is the number of the period. In this case, the period is based on year, right? So it's number of years. Okay, T here is 1, and for the first year's future value, and T equals 2, it's the second year future value, okay? So this factor, 1 plus r to the power t, this is called a compounding factor, okay? The effect of compounding, okay? So now let's talk about the simple interest. Simple interest means you earn interest only on principal, okay? So you invest $1,000, okay? Simple interest means every year you take the interest out. You take the interest out. You always have a principal of 1,000, okay? The interest you earned will be not part of the calculation of the future interest, okay? So the compound interest means that you keep the interest you earned in together with the principal, and the future interest earned will be calculated based on the updated balance, which includes principal and interest earned in the previous periods. Okay, so the compound interest is you earn interest on principal and the reinvested interest. Let's consider one example. In that example, the future value with simple interest would be, so let's see. So $50, so that's the first year one interest, right? Because you earn interest only on the principal. So what is the principal? Principal is the $1,000, right? Because that's what you have initially. So that's the principal, 1,000. So you earn interest only on principal. So the first year, the 1,000 times 5%. So that's the $50. And the second year is the same. So year two is the same. Use the principal is 1,000 times 5%. Okay. So now that's how you get this $250, right? Okay. And the future value will be the principal, okay, plus the interest, the simple interest you earned. Okay, so 1,000 plus 50 plus 50, that will be 1,100. The fair value with compound interest earned, we calculated this number in the previous slide. That's, I will show you. So that's the number with the compound interest, 1102.5. Okay. Okay, so then you may wonder, well, why compare these two numbers? The difference is 2.50. So where does this number coming from, right? So basically what it's come from is you earned interest because of compounding, right? This $50 from the year one interest, $50 is reinvested interest. So this $50, okay, will earn 5% for the year two. So for the second year, this 50% interest you earned from year one is reinvested, and they are earning the interest on year two. So 50 times 5%, that's the $2.5, okay? So I hope this makes sense. So it's, for the simple interest, it's almost like you have a principal and you earn the interest and you take the interest out. You only keep the principals in the pool to keep earning interest. And at the same time, you're gonna every time you earn the interest, you withdraw it from the pool, okay? But for the compound interest, you keep all the earnings in the same pool. And so that earned interest will generate new interest, okay? So that's called compounding effect. You can do these calculations with financial calculators. The recommended financial calculators for this course is the Texas Instrument BA Second Plus. Okay, this is the recommended financial calculators. And you will notice that it's kind of the third row of the buttons on the calculator. So my calculator has a color of white. Okay, those buttons are white. So FV, the button FV means future value. The button PV means present value. The I/Y, that's the interest rate. And the N is the number of period. Okay, so this is the third row of the button from the top. The third row, and in my case, it's the color of the button are white. Okay, so and make sure every time you do the calculation, you have to clear the registers after solving each problem. So you're gonna use the button. You're gonna press the button CLR TVM. So every time you need to clear the registries. Okay. This is one example. Suppose you invest $1,000 from the previous example for 5 years, and the interest rate is 5%. Okay, how much would you have? Well, you want to know how much would you have in future. So you are trying to solve a question to look for the future value. Okay, so the future value, okay, equals present value, which is 1,000. Times a compounding factor. So this compounding factor is 1 plus the interest rate, in this case is the 5%, to the power t. T is the time period. In this case, it's 5 years, power 5. Okay, so we calculated the number is 1,276.26. And you can also calculate this with using your financial calculators, right? So you enter 5, you press the button N. Okay, so remember the sequence, right? If you don't know how to use financial calculators, make sure that you learn how to do that. So here, when you use the financial calculator, you first press the number 5 button, and then you press N. Okay, so then they would assign the number 5 to N. So similar idea, press 5 and then press IY and press 1,000 and then press present value. And then you press the button to the left top corner, CPT button first. That's called compute. Just let you know what's the CPT represent. So compute FV, future value. So you get 1276.28, and you have a negative sign here. You have a negative sign here. So what does that mean? Is it means cash flow, right? It means the direction of cash flow. So your present value is 1,000. That means you are giving this money to the bank. Okay, so this is the cash flow away from you, right? Away from you. Okay, and then in the future, right? After 5 years, you're going to take the money out from the bank. So that'll be the money coming towards you, right? So you can see that in the beginning, you give money out. That's a cash outflow. In the future, you bring the money in, right? So the cash flow are opposite directions. So that explains why the sign, right, of the present value and the future value, the sign is the opposite, okay? The effect of compounding is small for a small number of period. So in our case, when we have 2 years, the compounding effect is not very significant. It's only $2.50, right? But in this case, okay, in this case, let's take a look. This is the 5 years, right? This is the 5 years. This is the 5 years. So the future value, if we consider simple interest, so that would be, so your principal 1,000 plus each year 1,000. Each year you earn 5%, right? And how many years? 5 years. Okay, you earn interest for 5 years. So this tells me, this part gives me 50 to 50 interest, simple interest. So my future value with simple interest would be 1250. Okay. But with the future value with compound interest is 1276.28. So compared to 1276.28. Okay. So if you compare these two, and the difference is $26.28. So that would be the due to the compound effect, right? That would be due to the compound effect. See, 2 years, that compound effect is only generate $2.50. But given a longer period of time, 5 years, that compound effect generate more money, right? $26.28, right? So in order to realize that compounding effect, you had to be really patient, okay? You had to be really patient. It's kind of like in our lives, right? Sometimes you were having a good habit, right? This little habit, little things. Let's say every day you walk, 1,000 meters, right? Every day you do it, right? Within 1 year, you probably don't see too much kind of difference, right? But just wait and patient. If you keep doing this for your whole life, right? You probably will realize that the health, right? The benefit of the health of doing these little things, every day. So the power of the compounding effect is really observable when you give enough time. So now let's take a look. Let's stretch it out to 200 years, right? You have $10. You have $10 sometimes. What can you buy with $10 nowadays, right? You probably will buy like one meal, right? One breakfast, right? So let's say you decide I'm going to think for my descendants, right? So I'm going to start investing for how many generations of descendants? 200 years. Wow, that would be like 10th generation, like 20. Yeah, you probably like the 10th generations after you. So you are really good ancestor. You decided to be starved one day to save $10 so that you can save some money for your far away children's of children, right? And then let's say 200 years, okay? So that interest you earned is 5.5%. So how much interest, how much money you would get, your descendant will get in the future? Okay, so let's take a look. So let's use the formula. So your present value is $10. Okay, you saved because you starved without having breakfast. And then this is a compounding factor, right? This compounding factor, 1 plus R, that's the interest rate, 0.055, right? That's the 5.5% in the form of decimals, 0.055. And to the power, this time the N is 200, right? And take a look at this number. Wow, that's almost $450,000 in 200 years, okay? So $10 will grow because of the compounding effect to that big number, right? Well, of course, right, it's your decision. Do you want to be starved from a breakfast, or you don't want to save money for the people after you that you don't know, right? And they probably don't even know your name. It's interesting how we can be forgotten not very long after our death, right? Sometimes people did a psychological experiment. They ask if they remember their grandpa's name. Very few people will know. But once they ask, do you know your grandpa birthday, right? So yeah, I think it's interesting. Will you do that? You can also use a calculator to do the calculation, okay? You will get the same result. So let's take a look at what is the effect of compounding in this scenario. So if you consider future value with simple interest, your principal is $10, and each year you earn $10 times 0.055 interest, and you earned it for 200 years. Okay, so this gives me only $120. So the future value with the simple interest is only $120 in the future value. So the compounding effect add $447,000, 79 cents, $79.84. Okay, that's the compounding effect. So if you take a look at this picture, if you have $1 at present, if you don't earn any interest rate, it's going to be always to be $1, right? So this 0% is the interest you earn. So if you don't earn any interest, this is going to be a flat line because it's going to be always $1 there. As you earn more interest, okay, you earn more interest. The future value is going to grow faster and quicker, right? So basically, if you take a look at the 7 years after, if you think about the 10%, if you think about, let's see, 5 years, sorry. If you think about 5 years, okay, 5 years, and then you earn, for example, 15% interest rate. So that will be this second curve line. And that's how much the future value would be. So you almost doubled, right? So 5 years, if you earn every year 15%, in 5 years, you almost doubled, okay? So the point is, if you want to have, if you want to have more future money, you probably hope to earn more higher interest rate, and give a longer period of time, right? Maybe you have to start investing now if you are hoping to get something on the retirement, right? Okay. So what about growth formula, right? Consider in the business, right? Sometimes we consider about growth projection. Suppose this company expects to increase sales units of widget by 15% per year for the next 5 years. Here, this 15% is not the interest rate anymore. It's a growth rate, okay? It's a growth rate. Currently, the principal, currently they have 3 million widgets. How many widgets do they expect to sell in 5 years? Okay, so present base is 3 million widgets. The growth rate is 15%, so that's 1 plus 1.15 to the power 5 years. So 5. So you have 6 million, over 6 million units. So you doubled, right? So if you earn 15% for 5 years, after 5 years, you doubled your principal. So that's crazy, right? That's really crazy. Now let's talk about the present value, right? Let's talk about present value. So we have learned the future value is calculated by a present value and a compounding effect factor, 1 plus r to the power t. What if I know a future value, but I want to figure out what's my present value? So what does this mean? For example, let's say I'm going to retire at the age of 65, okay? And I'm hoping at that time I have $2 million. So I'm hoping that at the age of 65, I will have $2 million, right? So this $2 million is a value that on the later money. This is the later money on the timeline, right? At the age of 65. So this will be a future value. So I know my future value, and suppose I'm right now 40, right? So there are n equals 25 years, okay? And let's say I'm earning an interest rate of 5%. I ask myself a question. Today, or I can say right now, how much I need deposit into the bank, right? So when I say today, now, right? So that's present value, right? So basically this question, I'm trying to figure out the present value, but I know the future value, right? So that's the scenario. You could, in a scenario that you know the future value, you know the n, you know the interest rate, you want to figure out what's your present value. So that's not very hard, right? So we can just reorganize this formula, right? Reorganize this formula. Okay, so we reorganize the formula. So basically, we have present value equals future value divided by 1 plus r to the power t. Okay? So if you remember, when we calculate the future value, we use a multiplication. But when you calculate present value, you use a division. Okay? Okay, so here, we talked about discounting together with present value. Why discounting? Because you know the future value, right? The future value is more than present value. So from future value, if you want to calculate the present value, you have to discount the future value, okay? To get a smaller number, which is the present value. That's why it's discounting, right? Normally, when we talk about the value of something, if we talk about the value, we talk about the present value, okay? Unless we indicate we want the future value, right? Because when we are talking now, we talk about the value now, the value is the present value. So unless we pretty clear that we are talking about future value, okay? In this example, okay, okay. So this question is, in 1 year, you will need $10,000. So in 1 year, so that's the later money, right? The money 1 year later. So this is the future value. And you earn interest, this is the interest rate, R. And in 1 year, right? In 1 year, so n equals 1. And so how much do you need to invest today? So that's our present value. So you are calculating present value. So present value equals future value, 10,000, divided by this discounting effect, right? 1 plus R, 0.007 to the power 1, right? So that's how I calculate the present value. So the result is $9,345.79. Again, you would use the calculator, you can get the same number, right? This time, what you do is you entered the future value first, and you compute present value. Example 2, you begin to saving for your daughter's college education. You estimate she will need in 17 years. So this $150,000 is the money the daughter will need in the future. So the $150,000 is the later money. So this is your future value, $150,000. In 17 years, that's your N, okay? And you are confident you can earn 8%, that's your R. And how much do you need to invest today? Okay, so that's the present value. So present value equals future value divided by 1 plus R to the power T. So future value is 150,000 divided by 1 plus R is 8%, 0.08 to the power 17 years, 17. Okay, so let's take a look. So my result is, so now you only actually need to invest $40,000. Okay, 40,540.34 cents. Okay. Yeah, as a parent, if you have young kids, as a parent, you probably want to invest earlier, right? Even when they're baby. Don't think, oh, it's a long way to go, right? It takes 17 years before they go to college, right? As soon as they were born, you probably want to start investing, right? Buy the RESP for them, right? The government will also kick in some money for you to help you out. So set up a RESP account. Example 3, your parents set up a trust fund for you 10 years ago. Now it's this. Okay, so the fund is how much did your parents invested. So if you draw a timeline, right? So this is now, but now does not always mean present value because you also have here 10 years ago, right? 10 years ago. So which time point is the earlier money, right? So on this timeline, this is the early money. The 10 years ago is the early money. So this is the present value. Now this is the, on this timeline, this is the later money, right? So this is the future value. So now it's worth this. So the future value is 19,671.51. And the N equals 10 years. And the interest rate R equals 7%. And they want to ask, how much did your parents invest 10 years ago? So you are calculating the present value. Okay, so present value equals future value 19,671.51 divided by 1 plus R, so 0.007 power to 10. So that would be my formula. So I calculate this, I get the result is the $10,000. So the parents invested $10,000 10 years ago. Okay, now let's think about the relationships between the present value and the length of the period of time, and as well as the interest rate. Okay, so suppose you have a present value money $500. Okay. Oh, sorry. In 5 years, you are going to receive $500, and the discount rate is 10%, right? So what is the present value? So you use this formula, right? So your present value is the future value discounted, right? Discounted the future value. The future value is 500 you're going to receive in 5 years. And the discount rate is 10%. So 1 plus 10%, 1.1 to the power 5 years, 5. So this discounted, so 500 in 5 years is now $310.46. Okay. So now, how does this present value is a function of the discount rate and also the time length? So now let's stretch it from 5 years to 10 years. Okay. So we keep the discount rate 10%, but we double the time period from 5 years to 10 years. So now my calculation shows that the present value is even smaller, only $192.77. Okay. So what does this mean? This means that if you are hoping to receive a future dollars 500, and the discount rate is 10%, if you only have 5 years to do that, you have to do a little bit more, right? If you have longer time to reach this goal, $500, you can starting with a lower number. So if you have 10 years, you can start with 192.77. But if you only have 5 years left, you have to start at a bigger amount, $310.46, right? So what we are saying is, if you have a time on your side, it's beneficial because you don't have to invest a lot of present money upfront. So you can have a lower present value. Okay. So if you have time, the discount rate is constant. The future value is the constant. You can have a lower present value. So now let's do something else. Okay. Let's keep the 5 years. Let's keep the time window the same. Let's say you can earn higher return, the discount rate, 10% to 15%. Okay. So then what is going to happen? Well, the present value would be $248.59. So still lower than $310.46. So what does this mean? This means that if your time window is fixed, okay, you want to reach a certain future value, right? If you know that you are going to have a higher return, your investment will be very successful, have higher return. So then you don't have to invest that much now, okay? So if you have higher return, you can invest less now. So higher return, less present value, okay? So what happened here is your time window is fixed, okay? If the interest rate is higher you earn, okay, the present value will be lower, okay? So this is a relationship. It's interesting. So if your discount rate, your interest rate is constant, the longer time window you have, okay, you have lower present value. On the other situation, if your time window is fixed, the higher of the interest return, the lower of the present value. Okay, so that's the relationship between present value and the interest rate and the time period. Okay. So this chart summarized all the equations. Okay, so maybe make sure that you understand these formulas. Okay, so that's it for chapter 5.